All right, so we're back. This is the Sonoma Brain Trust. We are here today with, we have a special guest, Linda Zaiss. Joining me, Daren Blonsky. I'm with Sonoma Wealth Advisors. We've got Mary Piazza with Hauser, Veluzzo, and Piazza here in Sonoma, and Chelsea Runnings with Better Homes and Garden. So glad to be back. This is our weekly update we're doing on Wednesdays. Today, by the time published, will be a few days later. But again, Linda, thanks for joining us today. We wanted to spend some time today talking with Linda because she is a very experienced professional in the mortgage industry and can tell us a little bit about what's going on in the mortgage industry. As you all know, rates have been moving quite a bit. Earlier this week, or I guess it would be last Thursday, it looked like we were going to have a negative rate in the United States come December. Jerome Powell, the Federal Reserve Board president, came out earlier today, this morning at 6 a.m., bright and early, and said that that's not going to happen, but we shall see. So with Linda here, we want to get a little bit better understanding about what's going on in the mortgage market.
Okay, so as far as people, when they hear zero rate or zero interest rate, or the rate's going to be a negative rate, it's not related to mortgage. Some people think that's all tied together, and it isn't. As far as mortgages go, we're seeing rates in the low threes. Pardon me?
Together?
What? Huh? Okay, keep talking.
I was just saying, why is that? Why when people hear negative rates and they automatically then assume my mortgage is negative then, right?
I have no idea. I think we need to get people educated on that because they're totally different. And I don't know the big differences. The fact that you brought that up last night and then I listened this morning that it's not going to be an occurrence for us, it's good. But people do believe that it's related to mortgage rates, and it just isn't.
And is that because there's pricing involved with what the Fed will loan rate money for, and then what you actually can get people to loan you money for? Is that the difference in the spread?
I think, yeah.
Okay.
And mortgage rates are tied more to the bond market. So a lot of times, which isn't been the case as much recently, but a lot of times if the stock market's doing well, the bond market's selling off, so our rates are increasing. And vice versa, if the bond market's improving and the stock market's selling off, then we'll have rate improvements. But we're not necessarily seeing that so much. What happened the beginning of March, we had a huge rate drop and like a fire hose worth of loans come into our industry. And most lenders didn't have the capacity, or they weren't expecting all this to happen. So the volume was so much that they couldn't handle it. We were doing locks up to 90 days. Some lenders are still doing locks up to 90 days because they just can't get through all the loans.
What does a lock mean, Linda? Can you explain that?
When you lock a rate, it's committing that loan amount to that investor to that rate. So we locked a ton of loans, and then we have to get them through the system and to the investor within that lock period. So typically we were doing 30-day locks, but we went out as far as 90-day just to make sure we could keep that rate for those borrowers and not have to extend, which there's always a cost to extend. But what's happened too is because of the volume, lenders have increased their rates. They've artificially increased their rates to stop the volume so that they can get through their pipeline of loans. But overall, they're still saying that rates are going to be low. We're in the threes, and I've done some rates like 15-year in the twos, 2.625 or something for a 15-year. And the expectation is that rates will remain low through the end of the year. And, I think we want to talk about purchase too. Should I get into that or?
Yeah, when you're talking about the rate locks that you're seeing where they had to put a pause, was that for refinances or was that for purchases as well?
They had to stop, they increased rates for volume. So it was both. Okay. They didn't separate the two, yeah. And as far as our company, purchases have always been the priority. So we still are closing quickly. If it's a 21-day close, we're meeting that mark. But rates are the rates, so that doesn't change. And what we're seeing too is now that the real estate market is starting to open up and we can start seeing the homes if they're vacant, We're seeing more offers now. I had multiple offers last week again. The price sold for slightly higher, one in San Francisco, slightly higher than the asking price. I think there's some worry about what's going to happen with housing prices and, all of that. But I think there's been buyers who have been waiting and sellers that still want to sell. So we're going to start seeing some movement in the market as far as that goes.
Now, Linda, have you seen anyone back out of loans during COVID, or is it just the same as it always has been?
I think it's been the same. I haven't really seen a difference.
Okay.
Yeah, that's staying the same.
So buyers' confidence is still out there to go forward and close these deals.
And I think more so now with where rates are, it's a big motivation for them to get moving into to buy their home. And again, the sellers, people who have to sell, still want to sell, and I don't see that we're going to see a big drop in price either. Some people compare this to what happened in 2008, where we had a lot of foreclosures and short sales and all of that. We have a lot of unemployment right now, but we anticipate people getting back to work. So it's not going to be like what we went through in 2008. That was all due to fraudulent lending, and people just literally couldn't make their payments. With this, people will get back on board, and I can't imagine that we're going to see the same market as we had before.
I talked about last week how everybody I keep seeing, like, I'm not going to buy, not everybody, because obviously from what I'm seeing, there's a lot of buyers, but there was a lot of talk primarily on Facebook where people were like, I'm going to wait for the housing market to crash so I can get that 5-bedroom for $200,000. But there's some very clear differences from the 2008-2009 crash and what we're seeing today. And like you touched on one of them, and you have 22 years of experience, so you really know what you've seen through the years. One of the biggest differences were those loans that people were getting back then, and people were so underwater on their mortgages. They owed more than what the equity they had in their houses, and they were getting loans that they couldn't afford even with their income. And then when they lose their job, they definitely can't afford it. So what changes were made after that crash to now, to where the lending has kind of tightened up to stop that kind of crash from happening again?
So what I remember is interest only was a big push. Interest only first and second, so people could buy a home, and they're basing their purchase or their ability to pay on only paying the interest. So I actually believe it pushed the housing prices up, because you got multiple offers, because you got more people in the market thinking they could afford more home, because they were only focused on the interest. And as interest rates changed, it had a big impact on them. So what's different now is we qualify based on your ability to pay the loan. Because again, we were doing stated income too, where you just stated what you made, which seemed crazy to me. So now you have to qualify. If we're doing a jumbo loan, the debt to income ratio can't exceed 43%. Below that, conforming's up to about 49% of your the debt to income ratio, and then there's a high balance range up to 45%, which means 45% of your income goes to your housing expenses and anything on your credit report. So we're making sure people can really afford the homes now that they're buying, so they won't get into a situation that's not going to work for them. And that right now, because of COVID, the things that are shifting more so with jumbo, they're pulling back on loan to value. So on a jumbo loan, I was doing an 85% loan to value. Now they've capped those at 80. With refinances, some of them are saying we're not going to do cash out anymore. So they're pulling back a little bit, but overall, our lending is still good. Actually, we're trying to minimize documentation, and we're working ways around not having to do appraisals. Like I have one today, it's a purchase in Groveland, that they did a desktop appraisal. So they physically don't have to be at the property, which is good for the seller. They don't want to have more people in their house than they need. And they just base it on recent comps and then the listing for the property to do the appraisal.
Awesome. Forbearances. We talked a lot last week about forbearances and how they were making some changes to how forbearances were going to work, and they weren't really looking into who if you really needed a forbearance, people were just saying, I need a forbearance, and reaching out to their mortgage servicers and getting those. But we were preaching last week, like, please pay your mortgage if you can. Don't just get a forbearance because you can. How does the forbearances affect the overall market? Like, how do they affect the lending industry? Because my understanding is the more people who aren't paying their mortgages, the less money there is to give out for future purchase.
Right, and it's going to all come due. The lenders they'll want their money. And some of them, I think if you have to go into forbearance, you really need to find out how they expect to be repaid. And now with rates as low as they are, we're having to check employment at the time we're funding, because people have been losing their jobs. We could start the loan, and by the time we're done, they don't have their job anymore. So we're doing verifications right before close. And if people are going to do the forbearance, it's going to look like they've had a hardship. So when they go to refinance when things are better, that's going to show on their credit. It may not affect their scores, and we understand why, but the lender on the other side may go, I don't want to do that. Like, we had modifications before, which made people, the lenders, more leery of working with those clients because they had an issue where they had a modification. So with the forbearance, I mean, they're trying to help, but I would say, like you said, if you can make your payment, make your payment. It's much better to do it that way than to feel like you have this easy out, because they're going to want their money.
So Linda, what about the people who are looking at bankruptcy right now? Do you have any guidance for them as far as like what their horizon would be to qualify for a loan 5 years out, 7 years out?
So depending on the type of bankruptcy, if you do a Chapter 13, which is where you set up payments back, they'll allow a 2-year time frame from the time it's finished to the time you can purchase again. If you do a Chapter 7, it's 5 years. So again, and then before we were doing short sale, took 4 years before you could get a new loan, and foreclosures were 7 years. So you kind of want to stay away from that because it has such a big impact on your future if you can avoid it. And of course, bankruptcy is there for people who really need that too. So it just will affect your ability to buy later.
Daren, you have any questions, any thoughts?
So I get questions all the time from clients that say, should I refinance right now? For example, I was talking to a client earlier who's looking at paying off their home, and I said, well, you might want to hold off because there's a good chance that rates are going to change here in the next little while. And currently the outlook is that we would expect rates on some degree to go down based upon the way the futures look currently. Argue both sides of that coin for me, Linda. So do we think rates are going down? Do we think rates are going up? And why? What would be that right now?
I think overall they're saying rates will continue to stay low and could go down near the end of the year. But what I do with my clients is, if it makes sense right now, because right now is a given, we know where rates are, we know if they're saving money, we know the cost of the loan, and we look at all that. And some say, yeah, it does make sense to do this now. And some say, no, I want to kind of monitor the market. We have low rates. I mean, I have clients that have rates in the 4s and 3.875. So we had low rates several years ago. So it's not, we want to just make sure it's the right decision based on how long they're going to be in the property, what the cost is. I wouldn't recommend paying points at all right now. And I do try to minimize
paying points.
So a point would, so interest rates, the lower you go in rate, the higher the cost. So we can do, what we typically do is just say, either it's a no closing cost loan where the lender covers the fees, or the client pays the fees, which could be $2,800 to $3,500. And those can be rolled in. So that's for par pricing. So it's not costing the borrower to buy that rate down. When you buy the rate down, typically it's a 0.1% of the loan amount to buy the rate down by a quarter. So because we anticipate rates possibly improving. I don't encourage that at all. If we were going the other way and we thought rates were going up and this was the end of low rates, then maybe people would be willing to pay the points. And on purchases, points are tax deductible. On refis, they're not. So it's just a cost that you don't need to incur, I think, because you still can have low rates.
Got it. Generally, what are the ballparks of the rates for like a 30-year and a 15-year fixed right now?
So conforming, so this is anything under 510, I'm seeing for a 30-year, 3.375 to 3.5, and the 15s and the 2s, 2.625, 275. Jumbo pricing is a little bit more sketchy because they're holding back a bit. So I've seen it from 3.625 to 4, depending on the lender.
Got it. Well, great, Linda. Thanks for taking some time to share a little bit about the mortgage market. If you're open to it, we'd love to have you back in the future, just giving us an update. We know it's a moving environment. We know things are changing rapidly. So thank you for taking the time. So Linda Zaiss with Guaranteed Rate here in Sonoma. So let's go ahead and transition to, I guess, Mary, and tell us a little bit about what's going on in the legal world and updates this week. What are you seeing? What changes? What trends?
Yeah, thank you, Daren. So I think in the last week there have been 3 major updates that I want to discuss and I think may be helpful. The first is that there's an inclination that with respect to the PPP loans, that there may be some ex post facto regulations going into place to limit the loans that will be forgiven. And I think that this is critically important for people who have received those monies to stay on top of. There's nothing solid at this point other than it's important for folks to track where the money's going if they have received those loans. But as things roll out more, it is important. The second huge thing is that we're starting to see businesses reopen. In California, we have now, as of yesterday, online guidance with respect to actual steps that businesses can start taking to prepare their employees and their environments to look at reopening. Sonoma County is a bit more conservative, but even Sonoma County in the last week has issued some guidance, and I'd like to share that here with everyone. So give me a moment. So this is the Sonoma County Business Mitigation Measure Checklist. There are 3 different areas to this. The first part is minimizing in-person interaction. The second part is daily monitoring of employee health. And then the third part are overall health and safety guidelines. So it's a positive thing that there is something now that businesses can actually go to, get their hands on, and start taking steps.
So let me interject real quick, Mary. So what I saw in one of those guidelines was monitoring health. How are they recommending we do that? Because that can get awkward, I would think, especially in a lot of small employee situations.
Right. And with the caveat being I am not an OSHA employment expert, and there is one who we have invited to bring on our talks in the coming weeks. But it really places a lot of emphasis on and responsibility on behalf of businesses to have their employees be checking things like their temperature. So this, going back to the 3-staged business checklist, it's asking employees' temperatures to be below a certain number, 100 degrees, that face coverings are worn, that the employees do self-assessments, and that also there's personal protective equipment in place. The local business community for the past few weeks has actually been asking when they will be able to reopen because there's a concern with a lot of these things. One, there's a concern about the customer experience, and even with the employee health requirements, whether or not customers are going to go to those businesses. But secondarily, the businesses are concerned about getting the protective equipment based on the limited supply. So I think practically speaking, there's a lot that has to happen for businesses here, more so for restaurants. The list for them it's huge. But in order to get them in a position to safely reopen once they get the go-ahead. But Daren, your question also dives into my third big update, which I wanted to mention, that in looking at both the California overarching guidelines for reopening as well as the counties, there's a real message here from the government that they are putting trust in the place of the businesses to monitor these things, like, you know, the employee health in a way. There's also self-assessments for businesses to ready themselves to reopen. So that's different than in the past, where the county would have an inspector go out and check the premises, right? So now you have government officials saying, you know what, here's a self-assessment checklist. You go through this and then you can reopen. I have an overall tip for business right now before you're reopening, to reach out to your insurance broker and see what kind of insurance you have. If you are in a position to maximize your insurance coverages, I would recommend doing that. This is because we're seeing litigation. There's litigation right now pending with respect to Tesla. There's forecasted litigation with respect to employee health as well as customer health. So, you know, even once the doors reopen for business, there is definitely the risk of future liability, and the way to protect yourself in some measure against that is to maximize insurance. There are other things that are on the horizon, but nothing that's as major as the past three that I've talked about.
You know, you bring up a really interesting point, Mary, because when we're looking at this from an economic perspective, the markets get really excited about the fact that things are reopening. Mm-hmm. What the markets aren't necessarily, it seems, taking into account at this point is the liabilities of reopening, right? Mm-hmm. So the ability to reopen, which is governing bodies saying, yeah, you can reopen. There's a lot of businesses also looking at the liability of reopening, mm-hmm. and the reality of reopening. Anything that has to do with people all in the same place has to be, at this point, really calculating out what is the liability here if we invite people back and they get sick.
Right. I think that the liability is unknown. So at the beginning of this, we had folks making claims under their policies, and certain claims were denied on the basis of a virus exclusion. So, you know, there has been movement to require insurers to cover that. And there are other types of insurance that are covering it, that are in place. But there, you know, with that and what we're facing, there is potential exposure. So then you dive into, well, how does that company limit their exposure? Right? Are there liability waivers? If you're a gym and you're reopening and you're saying, hey, people, you can work out in this zone and there are 6 feet and we're cleaning it. Well, what about the, you know, liability for your employees' health? What about the exposure if someone does get sick? So, you know, liability waivers are going to be potentially, I think, very important. I think, again, really understanding your insurance, pressing on your elected officials to make sure that certain claims are covered. And insurance policies are huge. And then with respect to sole proprietorships, you know, people can also consider limiting their liability by incorporating in a business form, so that if it's done properly, the assets at risk are those of the corporation and it doesn't extend to personal liability. So.
There's a ton that we've got to deal with as we reopen. Mm-hmm. And that goes to even, I think, leads into the other piece, is that if we do start reopening and we get a resurgence of cases, as we saw that in Germany yesterday, where they opened up and now they're looking at slamming the brakes back on because there's more cases. We've seen that in South Korea happening. We saw another outbreak starting in China. I think it's fair to think that here is a society in the US, because we are doing less testing per diagnosed case, based upon the facts, it's going to be really a difficult start-stop process, right? And wow, I mean, just understanding all this liability is huge. What's the top thing, Mary, you would say that companies need to assess before they reopen from a legal perspective?
That's huge. I think, honestly, I would go with their overall insight on how they'll do going forward. So we have businesses who are looking at reopening, but they're choosing not to because they're forecasting that there may not be the interest there. From a liability point of view, I think it's that call to the insurance broker and really understanding what coverages they have.
Right.
So Daren, what are you thinking about the market update these days?
You know, this last 24 hours has been very interesting. We're at a pivot point here in the market and looking to see what happens. I'm going to go ahead and share the screen with you because I'm a visual guy and I love to dive into the tea leaves a little bit. And, you know, again, anytime I talk about the markets, I always have to say that you shouldn't be taking this advice and enacting on it in your portfolio. You should talk to a professional before you do it. As a point of disclosure, but I'll tell you what I'm seeing generally. So in front of you on the screen, you can see the S&P 500. This is the SPX, which is the globally traded index fund of the top 500 global stocks. So the biggest companies based in the US traded globally. And the reason why I use a global index is because it's a global world. And this market is traded 23 hours a day. So when you wake up in the morning and you just look at the New York Stock Exchange, the reason you see it gapping up and gapping down is because it's been trading while you've been sleeping. So this helps us get a better read on what the overall trends of the market are, the behavior of the market. And some of the tools we use are technical indicators. There's two types of analysis, fundamental and technical. I'm going to dive into some technical for you today. Technical analysis looks at the price action, looks at just purely how do things move up and how do things move down and what's the symmetry and what's the mathematical patterns. Because the markets are run largely by the computers these days, this can be very helpful in understanding what's going on. So what you see in front of you is this climb up here. That was the S&P 500 up until February 19th, which was the high. And then we dropped down in a very aggressive way. That was the fastest fall from the top to a bear market, which is 20%. We did that in 17 days. The record before this was done in 42. So it's an incredibly fast fall in a very short amount of time. And we bottomed out on March 23rd. We've now since climbed up, and we call this a retracement from a chartist perspective. It's an expected move when you have a leg down in an economic situation like this. There's a lot of people saying, hey, it's going to go back up and everything's going to be great. Unfortunately, the markets aren't necessarily telling us that if we dig into the numbers a little bit. So when you look at the market here, this retracement here, this market actually retraced to 61.8% of its down. And those are what we call Fibonacci lines, and it tapped those Fibonacci lines twice and then went down, which is a very bearish symbol. So there's bears and bulls in the market. The bears are fighting the bulls. The bulls think the market's going up. The bears think the market's going down. They're battling it out, back and forth, back and forth, back and forth. And we're sitting as the umpire on the sideline observing. And so as we observe that and we look at these charts, we would say based upon the fact that the bulls tried to run the market up to that 61.8 line, which is if you go back to 2008, 2001, the last recessions we had, the market retraced to between 50% and 61% of its down in both instances before it went down south again. So now what we're seeing is that retracement has taken place. We're seeing the market start to tail down. There's also something that's also really important that I want to show you, a couple things. So the first line you see on the chart is this red line. That's a long-term trend line, and it's a down trend line, and you can see it's been an important line for a long time in the market. You can see right around here it was resistance and support. So it's support when it's above, it's resistance when it's below. And you can see the market on its way down in February tapped it, right, and was testing it to see if it can go higher and got rejected, and that's called a rejection. You can see the rejection again taking place over the last few weeks on the chart. And then I want to show you another line, this diagonal line here. This is a really important line because it's the bottom of what we call a head and shoulders formation in the charts. A head and shoulders formation is a formation we see happen in the charts to tell us that the market is topping out where it's currently at. In the last 24 hours, we've had a confirmation of this. And so if you kind of imagine there's one shoulder and there's the head, and then there's the other shoulder, and then you go below what's called the neckline, which we just did in this last 24 hours, which is a bearish signal. That's telling us with a high probability the market is probably topped out. It's probably going to see some further downside. How low? We don't know. So what I wanted to do is to give some sense of probability of how low. So first off, it makes sense that we would at some point probably test the low that we have seen back in March. It's going to take a while to get there potentially, though. There's a lot more support by the Federal Reserve in the market, so it's not likely we're going to fall as fast. We could, we don't know, again. But this green line here you see is called a support line. And you can notice it's actually a really important one. You can see the market back on April 21st bounced off of it, tested it, and went back up. So it's a good chance that that's going to be our location of some strong support. The market would have to break that support before it would go further. And just to show you how important this line is, if we go all the way back, remember in the market back in June went down for a while, it tapped that support line. You can see it bouncing around this support line here right before it dumped down in December of 18. And you can see it bouncing around that support line all the way back July 2018. So again, markets move in patterns. It moves in symmetry. So that's going to be a line that you'd probably want to watch, and that's somewhere around 27, 22 on the S&P. Again, these are probabilities. We don't know what's going to happen. All we know is that we can look at the symmetry and look how the market's behaved in the past. And based on history, you can expect some further downside. So what would change that? Where would this be wrong? Well, you'd be wrong if the Fed steps in and starts buying the stock market, the Fed starts buying debt markets more, because basically what the Fed is doing now is they're gobbling up all the debt markets and making it very unprofitable for people to invest in debt. So where do they invest? They go back to the stock market, and that's what pushes it up. So there you have it. That's a lot, all in a few sentences, but currently the outlook is we're currently expecting a higher probability of downside than we are upside. And we shall see how it plays out this next week.
So Daren, let's talk about long-term recovery. I know there are different models out there that people are suggesting might happen. And last week, people are talking about an L-shaped recovery model. So what are you seeing out there?
So let's explain what an L-shaped is first. So if you are to take an L-shaped recovery model, what you're looking at is you would effectively see a market that drops and flatlines, right? Mm-hmm. The only way you're really going to see a flattening effect is if the Federal Reserve steps in and basically holds the markets up. So the government's basically propping the markets, and then it bounces around the bottom until we find some good news and eventually work our way up. That's possible. Even Buffett, the Oracle of Omaha, got caught, and I think we talked about this last week, and wasn't able to really invest his $132 billion that was sitting on the side because the Fed stepped in so quick. Possible. It's not likely for history. I mean, history, if you go back to the markets, I'll go back to and let's look at what we call the weekly chart on the market. So again, this is SPX. I'm going to switch over to the S&P. Let me just move this. And the S&P, if you go back historically, which is same as the SPX, but it's just traded just in the US or in the New York markets. And if we dial into 2001, what you notice in these recessionary times is that the market goes down on a first leg, retraces, and then goes further down. And that's how the market moves. It's very unlikely we have an L because there's no history to support L. Doesn't mean it can't happen. There's just not a lot of history to support it. So if you look at again here, market goes down, it retraces, goes down, retraces, and drops down, and then finds a bottom at some point. The average recession is 15 to 18 months. We're very early into this one. The unemployment numbers are off the charts. Any of the economic data you look at is off the charts right now because the market's forward looking. It's saying, hey, markets are going to open up, things are going to recover, it's going to look good again. What takes that off the table is COVID keeps continuing to be the pest that it is and pest all of our lives and make a mess of them. And if we don't get a handle of that either through a therapeutic vaccine or get some kind of herd immunity and / testing, it's very unlikely that we're just going to see a recovery right away. Well, that's a lot. That's kind of dire, but that's what we're looking at. That's what the tea leaves are saying today.
So Chelsea, speaking of markets, what are you seeing with respect to the real estate market right now? I know Linda spoke about financing it, but
yeah,
anything else go through?
we're seeing a little bit more, some more glimpses of hope than maybe what we're seeing in the financial market. But in the real estate market, we are continuing to see signs of life. We have another week of pending sales and new listings on the rise again. I think this is maybe the third or fourth week consecutively where we've seen that rise happen. And like Linda said, people are taking advantage of those low interest rates. Linda, correct me if I'm wrong, but I think it was a 15% increase in mortgage applications over the last week and a half or 2 weeks. So
Yeah, that's true.
Yeah, it continues. The people are out there trying to buy and take advantage. And one thing we're seeing is a lot of investment homes are starting to go on the market more as the Airbnbs aren't being able to do those rentals. And if they're not able to do the long term, you know, a lot of these Airbnbs are kind of like the small mom and pops, and that's how they pay their mortgage. So now they're maybe living in their primary house and have this other house that they're not collecting that income to pay their mortgage. So we're starting to see those come on the market more frequently. And just the home prices are staying strong. We have a little bit of a dip, not much, not double digits or anything. And I'll share with you guys April's market. So you can see overall in Sonoma County, we ended April with 246 sales, which for seasonal, that was a 32% decrease. But from March, we, let's see, we have it here. We had 296 sales in March for the county, and we ended April with 246 sales. So it's about a 17% decrease, but not surprising consider we went into lockdown, mid-March, and real estate wasn't considered an essential business for a few weeks. So we weren't doing business then, and as we were allowed to start doing showings more, business started opening up more. And now we can show to occupied, any house that's occupied, we can show it now just with some strict regulations. I think I mentioned last week, one of the biggest issues we're having in the market is still the supply and demand. The buyers are still out there. We still have more buyers than we have inventory. And more so now, I think, because home is kind of our safe place right now, right? Like stay home, stay healthy, protect yourself. And so sellers maybe are reconsidering putting their house on the market because they don't want people coming into their house right now. They don't want the unknown of coming into their house. So maybe they've held back on putting their house on the market a little bit, but those buyers are still out there. And while those buyers are out there and that demand is out there, those home prices are going to stay strong. So glimpses of hope again, I think a little more exciting than what we're hearing in the stock market and the financial market. And I think the real estate market is going to stay pretty steady. And like we discussed with Linda, vast differences from 2008, 2009, and now. I don't anticipate that we're going to have that major housing crash that people are thinking. Just because we're going into a recession doesn't mean the housing market is crashing as well.
Mm-hmm.
So it's still uncharted territory, but.
Yeah, Chelsea, if I could just interject real quick, I think you made a really great point, because so often we attach the economy to the stock market and vice versa. And the fact is they're different, right? And then you have micro economies, right? And Sonoma County is its own micro economy. And there'll be different influencers that could hold up the real estate market here that you might not see somewhere else.
Right. And I think one thing to keep in mind is the Bay Area is so techy, we're such a tech hub. So employment in those areas is going to stay strong. And now as we're working remotely, we might see more of those city workers who aren't going to have to commute anymore, maybe move into like the Sonoma, Petaluma areas and continue working from home, doing their city work, but being here. So they're going to need to buy real estate here. So for home sellers who are thinking that the market is down and the buyers aren't out there, same story, they're out there. They need some houses to buy.
Well, and Chelsea, what's the situation with the type of buyer right now? I'm hearing whispers of, multiple bidding war type situations, some things going for over asking. Is that accurate?
Yeah, so there are, if it's priced right, you're going to get those overbiddings, you're going to get those multiple offers. Real estate is all about pricing, really. If you price it right and you have the right kind of demand for it, you're going to do well. And so we are seeing some of those multiple offers. I haven't seen those, but the sales that I do are a little different because I do probate sales. Sometimes the houses are not necessarily in their best shape, or they're not as appealing as a move-in ready house. But I'm also seeing some more first-time home buyers taking advantage of the loan options right now. So they might not necessarily be out there overbidding, but they are still making some strong offers.
Elsie, what's a probate sale? Just so everybody understands.
So a probate sale is when someone passes away without an estate plan. They don't have a trust. So the house has to be sold under court supervision so that the beneficiaries and the creditors of the estate can be paid off.
Got it.
So, and generally those homes, if somebody's passed away, maybe it was an older person who didn't have a lot of time or money or energy to be putting into the house. So sometimes the houses are a little more outdated and need a little more work. Sometimes they're great, they're beautiful, but more times than not, I tend to get houses for sale that could have someone come in and really make it their own, so you could get a great deal on them.
I imagine in Sonoma, with the age of the population, that there's a lot of probate sales that happen in this town.
Yeah, although it's interesting because the courts have been closed, so I haven't really had anyone calling me lately to list any houses through probate, and Mary probably knows that as well, that with the courts shutting down, there wasn't any probate hearings or anything being set, so that all kind of came to a standstill.
Well, the update on that is that the Sonoma County courts are now in the process of taking certain matters forward. So things are being heard in the probate department, et cetera. So, it's positive. It's like the courts are adjusting to this time. And we talked about that a little bit last week with the implementation and use of technology, and we're seeing it there as well. But I would say with respect to probate, to add on to what you're saying, Chelsea, another major difference is the length of time it takes to sell the home, right? Because you are under that court supervised process. It's not your normal sale where, say you could list it and take an offer in 5 days or something. It's not that type of process at all.
Yeah, exactly. And right before everything in COVID happened, I had a house that went into contract, but this one was a trust sale. So we had to get all the brothers on board to agree to the sale. And she was so excited for the sale. We accepted her offer, and 3-4 days later, she backed out. She was so freaked out about everything that was happening in the economy and with COVID that she was unsure she wanted to make that step. And then her agent called me a week later and was like, she wants to go. She wants to do this. She doesn't want to pass up this house. She feels strong about it. So we actually closed escrow on it last week. So you had mentioned earlier, are people backing out or, canceling their escrows? I think that initial fear maybe shook some people, but as we're continuing to move through this new phase of life, I guess, people are learning to adapt and move with it.
Chelsea, what do you think is going to help sellers have confidence? Because I think it's fear-based that they're not wanting, like you said, not wanting people in their home, but it's a great time, it seems, because of rates and because of the amount of buyers we have to get them to list.
Yeah, that's a great question. I think, one of the biggest things is, in order for us to continue showing homes, we have these really strict guidelines and rules that we have to follow. You have to wear booties when you go in, you have to wear face masks and gloves, and you cannot touch anything. So nobody's touching your personal belongings. They're not opening cabinets. They're not, looking in the closets. And only 2 people in at a time. They have to be from the same household. There's forms and disclosures they have to fill out before they can go, saying that they haven't been sick, they haven't been around anyone that's been sick or been experiencing flu-like symptoms. So I would say it's just like when you go to the grocery store, right? You take all the precautions necessary to make sure that you're being safe. And when you come in, you do what you need to do to make sure your family has been safe after you've been out there and been exposed. So we're being safe with it, where we don't want to be shut down to where we can't show real estate anymore, because everybody needs a home and everybody needs to sell for a reason. So we're going to take that seriously and continue to follow the safety protocols to make sure we can get people into your house as safely as possible.
And the other thing, they're not allowing broker tours anymore, where you'd have all those brokers go through the house. So that's gone.
Right. No brokers tours and no open houses. So that's all virtual still. So you're not having 20, 30 people come in your house. You're just having a small handful of people maybe coming into your house throughout a few days.
Right.
So that's my update. It's, you know, we're looking a little brighter every day.
Well, great. Well, thanks. Any closing last pieces of updates from anybody?
That's it. It'll be interesting to see where we're at next Wednesday. It feels like every day there's some new stuff happening, some new developments. So I'm excited to look back on our videos in a couple of months and see all the things that change week to week.
Like, if only I knew when that happened, you know? Same thing. Every week I'm like, gosh, we're only talking about next week, but the markets deliver.
Yeah.
And there's plenty to talk about. There's a lot of change. Again, Linda, thanks for joining us today.
Thanks for having me.
Thanks, Mary.
Thank you.
Kelsey.
Should we add our big caveat that this is all for informational purposes only, that none of this professional advice creates a personal relationship or professional relationship between the viewer and us speakers.
Thanks, Mary.
You're welcome.
That's why we need our lawyer in the house. Well, have a wonderful week, everybody.
Thanks.
Thank you. Bye.
Bye.